the exact opposite. So the market, of course, rallies at certain points in time, but then continues to keep falling. And we are now officially in the US in a bear market. So the S&P 500 went through that 20% drop from the highs in January, went through that 20% drop overnight. So we're now in a bear market. So let's look at buy the dip and look at it historically. All right, so I went back and I looked at, and there are a lot of similarities. So people who listen to our podcast know for about a year and a half, we've been going on talking about the similarities between the speculative excess we've seen in the market, particularly since the COVID crash, speculative excess we've seen there, and then what happened during 2000, because the same things were happening. Yes, there are different things, there's Bitcoin now, instead of some of these internet stocks, but same thing, a lot of things without fundamentals, a lot of things without earnings, and sort of this frenzy of buying. So let's look at what happened during this market. So you can see exactly in March 2000, so this is looking at the S&P 500. The NASDAQ, of course, if I did that, it would be an even steeper drop. But the S&P 500 peaked in around March of 2000. So I guess a little bit later, the NASDAQ peaked in March. And what spooked the market was that Federal Reserve started raising interest rates. And then eventually, of course, all of this builds on itself. And as people become more fearful, the market continues to fall. But what you can see is there were lots of dips. So if you keep buying the dip, you would keep buying the dip going down. And that is, in fact, what a lot of retail investors did. So if you look at inflows from retail investors into funds, and there's some ETFs, this is actually an ETF back then, there were continued inflows throughout 2000. So as a lot of the tech insiders who had started all of these unprofitable internet companies were going public, and then the insiders were bailing out and selling their shares, retail investors kept buying. And institutional investors started selling their shares. Retail investors kept buying. And we're seeing, and what they were doing in many cases was buy the dip, right? So they were conditioned to think that, of course, anytime the market falls, it's an actual opportunity. And we're starting to see some of this behavior now. So if we look at inflows this year, we've seen that there have still been positive retail inflows. So that means retail investors are still buying, while institutional investors are selling. So once again, not a prediction about what's going to happen, but we've seen a lot of these similarities. And so what we talked about in this podcast episode in early January, I believe we called it a sale worth skipping, was that there are a lot of reasons why the market could continue to fall. And we were looking mainly at valuation levels, which were still historically high, and frankly, are still historically high, even with what's happened. But be very careful with this notion of buy the dip. And what buy the dip actually entails is it means that you are finding extra funds to put into the market. So the one thing I would say is that if you do have a saving and investing plan, and you've gone through and established that plan, which is a really, really important thing to do, it's fine to continue to make those contributions. But it's this notion of trying to shove extra money in the market, which is market timing, every single time it dips. That is the thing we're a little worried about, because it really isn't based on fundamentals in any way. It is simply based on the fact that the market has fallen and just a reflexive reaction to that. So a little bit to think about in terms of buy the dip. And, I will say, obviously, we had no idea what was going to happen with the market. But what we were trying to say in that January episode was just the fundamentals of the market. The valuation levels of the market were still historically high. And that is not a good time to sort of push your extra poker chips out in the middle of the table. Use a little bit of a gambling metaphor, since a lot of this was gambling. So that is buy the dip. So once again, have a plan, stick to your plan. You're going to make those decisions off of fundamentals, not the fact that the market fell. So that's buy the dip. All right, value and dividend traps. And obviously, anyone I give the general advice warning at the beginning, but I'm happy to answer questions. So if anyone, as long as it's not personal advice questions, if anyone has questions about what's happening or what we're looking at here, let me know. All right, so let's talk about value and dividend traps. These are other issues, of course, that we run into, particularly when we see markets falling. So we'll go through a basic definition of both. So what is a dividend trap? Dividend trap is basically when people are blindly buying based on dividend yield. So dividends are really important. Dividends are a huge source of returns historically, and they vary by decade. And obviously dividends aren't a huge source of returns when we're seeing market valuations go up and having that be the driver of returns, but they're still a huge source of returns. I think going forward, given what's happening, I think as investors turn back to fundamentals, they will probably be more important. Now, things are obviously a little bit different in Australia because of the tax laws here. People are more interested in dividends than they are and have not deviated, especially with the types of companies that trade here locally, have not deviated away from that, but they certainly have in other places. And now you see some of those dividend shares doing relatively better as investors go back into it. But the notion behind a dividend, so I do think dividends are great. I do think they're a really important source of returns, but we can't just extend that to say, okay, well, that means we're just going to look for the highest yield possible. Now, the yield refers to dividing the amount that's paid out from a dividend with the share price. So of course, as share prices fall, yields go up. And I think there's a lot of reasons. We'll get back to that. I just want to do the definition, but there's a lot of reasons we need to be very wary of that right now. But basically, dividend trap means that people are just looking at that high dividend yield and they're buying based on that high dividend yield. And then, of course, that doesn't work out. And a similar trap is a value trap. Now, a value trap is when, instead of looking at dividends, but pretty similar, what we're looking at is relative valuation measures. Now, relative valuation measures refer to something like the price to earnings ratio, where we are simply looking at price divided by earnings. So of course, as price goes down, as the market falls, those relative valuation measures get cheaper and cheaper and cheaper. But once again, we need to understand that shares are going to trade at different valuation levels based on their actual fundamentals and based on a fundamental analysis. So some shares deserve to be trading in higher multiples. Some shares deserve to be trading at lower multiples. Not a good or bad thing necessarily, but as investors, we need to be careful, especially in markets like this, where we've had that rotation back into value and value is outperformed. We have to be careful that we don't keep reading all of this stuff around growth shares and tech shares and how terrible they are and how they don't make any money. And some of them are, but holistically, and decide we're just going to go and find the cheapest shares to buy because they could be cheap for a reason. So I've got an example, and then I'll talk a little bit about why these two things matter right now. I've got an example, and I picked an example of a share that I actually own, a company that I own and have owned for a long time and has done really poorly. But I thought that would be a good example, nothing like my own shame and poor decisions to frame this thing. So in October 2002, IBM was trading for a PE ratio of 24.82. So IBM, and for newer investors, maybe you don't know this, but IBM used to be a really innovative company. And it used to be sort of at the forefront of technology. And certainly going into the dot-com era, people started to talk about IBM as being, okay, so maybe it's one of these stodgy old technology companies where we want to go buy pets.com and the rest of this internet stuff. But either way, IBM still was a company with pretty good fundamentals, company with earnings, very conservatively run company. So you can say it's trading for 24.82. Now, that may seem cheap now if we compare it to valuation levels, but that was on the more expensive side of the market, especially considering in October 2002 was kind of when the technology side of things, the NASDAQ, really kind of hit bottom. So 24.82. So I've only gone back the last 10 years. But these are the P ratios that it has traded for over the last 10 years. So you can probably sit there and say, all right, this is a lot different. And what happened in between these two periods, 2002 and 2012, in that decade, there are a lot of people that looked at a company like IBM and said, okay, well, it's actually trading for a lower multiple because it obviously went down for 24 to 11.8. It's trading at a really low multiple. The multiple keeps going down. This is a great value opportunity. It's a great share for me to go in there and buy. Well, as you can see, the market sort of collectively changed the valuation level that they were willing to pay for IBM. Now, a lot of things happened during this period as well. During that period in 2012, a lot of things around the company, of course, started growing a lot slower. It was not seen as innovative anymore, really missed out and was not at the forefront of a lot of the things that recently have happened around the cloud that Microsoft did so well with, Amazon did so well with. So the market really changed its opinion. And remember, a valuation level, all that signals is expectations for the future. Right, so a really high valuation level means that investors have very high expectations for the future. A low valuation level means that they have low expectations for the future. Now, if we look at those two things together, obviously low expectations are easier to beat, and that's when a share price can do really well. But in the case of IBM, I think investors, and not me, other investors, of course, were right, that they saw that this was a company that was having a very difficult time keeping up with a lot of its competitors and was getting surpassed. And they, of course, were right. So whenever you're looking at a valuation measure, you need to also understand the fundamentals. And now I can get back a little bit to the market and a couple of things that I've been thinking about in terms of value and dividend traps. So two things we need to be very wary of is the run-up that the market went on, really from the GFC up until, well, now we're in a bear market. So up until January of 2022, the run-up was driven by two different things. First, it was driven by changes in valuation levels. So investors were willing to pay more for shares. So that, of course, pushes their price higher. I'm willing to pay 20 times earnings for shares. And then 2 years from now, I'm willing to pay 30 times earnings. You're, of course, going to get that in returns. The other thing that happened is through earnings growth. So, of course, if I'm willing to pay 30 times earnings and they're also growing, then all of a sudden the share market goes up. So those are the two main drivers. But if you dig a little deeper, and this is where we need to worry about earnings, of course, where valuation levels are sort of fixing themselves with what's happening. If we look at earnings and we deconstruct earnings, and I'm actually writing an article on this that hopefully will be published later this week. You deconstruct earnings, you can see that a lot of the earnings growth was driven from margin expansion. So now margin expansion, a margin refers to how much of whatever a company, whatever good and service a company sells, how much they keep as earnings, right? So we're looking at top line, and we're looking at bottom line. There's different margins, but overall we're looking at, you sell $100 worth of goods, how much actually comes out in earnings, right? So if you sell $100 and you keep 10, you have a 10% margin, right? Which is good. So we've seen margin expansion, and we've seen margin expansion for a couple different reasons. Number one, taxes, especially if you look at US. So Trump had a pretty big cut in corporate taxes. So of course, that means companies earn more. We've also seen, of course, continued globalization. So we've seen companies be able to offshore and outsource a lot of manufacturing capabilities. We've seen just-in-time manufacturing, right, where we don't have to keep inventory. These are all costs as companies. We don't have to keep inventory. So if I'm building cars, the parts for the car show up the same day that I'm going to put it in the car. So we've seen a lot of that happen. We've, of course, seen wages not grow as fast as corporate profits. And if you go and look at corporate profits, they made up a bigger and bigger percentage of GDP, which just means of everything that we are creating in the economy. And everyone who benefits from that, whether that's governments or people or companies are keeping more of it. So quote unquote, companies were winning. Of course, we've seen a lot of that reverse lately. So we saw very, very large margins, even up until the end of last year. But historically, they have been very different from what historically they are right now, very different than what they've been. And now, of course, we're seeing a lot of different things that are potentially going to impact these margins. So number one, we're not going to get the same boost from corporate tax cuts. I can't really see any country, given all the debt that's been taken on since COVID, any country cutting corporate taxes again. So we've seen that happen. We've had a rethink since COVID of this whole notion of globalization, right? So a lot of countries and a lot of people and a lot of companies are very worried about their supply chain. What they're doing is they're bringing that closer to home. We've heard about this from politicians all the time about self-sufficiency. But all of a sudden, this notion that I can just in time make something in China, put it on a ship, have it show up, go into my factory, complete whatever I'm making, and then sell that. I think a lot of people are worried that that is not going to happen anymore. So we've certainly, number one, seen it through trade wars, different tariffs that have been put out, but also just the bottlenecks that have happened with COVID, which are really impacting the economy, really impacting inflation. Obviously, we have inflation in general. So with commodities and all the other inputs into products has gone up a lot. People are very worried now, of course, with wages. What is going to happen with wages? Obviously, that's good for us if we're making more money, but that's not good for you if you are actually, if you are an investor in a company. Of course, you want to make more money. And then, of course, we have ESG. So ESG obviously is very controversial. Probably more than it should be, but ESG, of course, is a giant added cost. And if we think about some of the stuff that's happening in Australia right now, is when electricity was invented, that of course was a great thing. If you are in something like 30% of the world that still does not have electricity, you are just looking for any electricity. But at the end of the day, what we're really talking about here is we're talking about, as worthwhile as it may be, we're talking about swapping out one way to generate electricity with another way. It doesn't really benefit me at all. It benefits the environment, yes, but I'm still getting electricity. So it's not really innovation that's changing anything other than benefiting the environment. And there's a huge cost associated with it that we're all going to pay, companies, people, everyone else. So a lot of these measures, of course, are driving up costs for companies. So to get back to value and dividend traps, something that we need to be very cognizant of is that even as valuation levels fall, and whether we avoid a recession or don't avoid a recession, I think we have to be careful about profit margins for companies. So, of course, if a profit margin drops at a company, if they're keeping less of what they sell, and those sales aren't exactly growing a lot, that could add to problems with dividends. It could be dividends being cut. From a value trap perspective, be very careful that when you're looking at a price earnings ratio, that of course is backward looking. Just looking at what did they earn last year versus what is the price. So that price can be falling. It can look really good until, of course, earnings come out. We're starting to see companies, including Microsoft, which everyone loves, we're starting to see companies start to issue these profit warnings as all of this inflation sort of flows through a company balance sheet. So just a couple of things to think about, that these can also be traps with the market right now. So what should you do about this? Well, one thing I would focus on to make sure those dividends are sustainable, to make sure that you are not getting lured into a value trap, is to really, once again, understand the fundamentals of the company. Do they have an economic moat? Can they withstand competition? Can they pass on price increases? So your ability to have a sustainable competitive advantage also means you generally have the ability to pass on price increases to your customers. And that, of course, can mean that hopefully you can maintain your margin better than some other companies that can't. So I think getting back and looking at fundamentals around a high dividend yield, looking at the payout rate, looking at the financials of the company. So once again, another increase in cost that's happening in the company is borrowing costs. So of course, with interest rates going up, it costs more to borrow money. So just a lot of different things to focus on. And I think now is the time to go back and start looking once again at all these fundamentals, all the things that you would learn in investing 101, hopefully all the things I've been talking about for the last couple of years, but go back and look at those. Whereas before, it's kind of buy the most speculative investment and it will probably go up a lot. So it does seem like the market is at a bit of an inflection point. So we can't just reflexively go and buy something that's dropped with a relative valuation measure or something that has a high dividend yield. We have to make sure those are maintained. And just remember, even if you're getting a lower yield, that's maintained, that's better for you as an investor because the yield is also backward looking. All right, so we got a couple questions. That was my weird market rant. Okay, so anonymous attendee said, what are normal P ratios for shares and financials, miners, and industrials? Well, there is no normal, right? So, I think we just need to be careful about normal. What we do need to talk about is, and I think it's a good question, what we do need to talk about is P ratios across different industries. So investors are willing to pay different amounts for earnings in different industries, and that is perfectly natural because there are some, this does not make it a better investment, but there are some industries where it's just better to be there as a company. So let's use miners, for example, versus technology. Now, obviously, technology has gotten hammered a lot, but if we look at technology, as I've said often on here, technology is a great business. So if you sell software, for example, it's a great business because you don't need a lot of people to produce it, which means that it's very, very scalable. So I think we use this in a podcast example that if you are Microsoft, once you have designed Microsoft Excel, it takes a certain number of engineers, of course, to do that. Once you've designed it, that's sort of a sunk cost, but also a cost that, of course, if you exceed in terms of how many licenses you sell, almost all of that, once you've exceeded the cost, is pure profit. There's obviously marketing expenses, there's a couple other expenses, but it's not like making a car, right? So a car, of course, you still have to make the car. And we did this in our Tesla example from the podcast. You still have to make a car. So every car you sell, you have to make a new one. But when you're really dealing with something like intellectual property, which is really what software is, at the end of the day, you don't. So those tech companies are very, very scalable. And so investors want to pay more for that or will pay more for that because they have higher margins. They generally have less cash that needs to be invested into the company. So very cash asset light companies. You don't have to have a big factory to create software. You just have a couple people sitting around at a computer. So you're always going to pay more for different types of companies. And if we compare that to all three of these, financials, miners, and industrials. So let's go through each one. We can start with industrials because I already talked about it a little bit. Generally, when we're looking at industrials, we're looking at, companies that need factories to produce a good. So that, of course, takes a lot of capital. It makes it more difficult to scale. Once again, I'll use Tesla as an example because Tesla is not a technology company, as much as people like to say it is. So what are they desperately trying to do right now? They're desperately trying to build new factories, build bigger factories, and they're doing this because they're trying to scale up production. And that takes a lot of capital. So they have to spend a lot of money to do that. It's big assets that are sitting there on the balance sheet. So that's what we worry about with industrial. So you would want an industrial with a significantly lower price earnings ratio. Now, Tesla's is very high, but significantly lower because it's a very capital intensive business. We talk about miners, and I think we take some of this stuff for granted a little bit because they are incredibly efficient. If you look at a company like BHP, is incredibly efficient, but at the same time, it is very hard, right? It's very hard to dig something out of the ground, put it on a ship, get it to the ship, put it on a ship, ship it off to, most of the case, China. That is also a very capital intensive business because mines, of course, run out of resources. You have to go explore, find a new mine. You have to develop that mine. I think that we have been, I would say that it is amazing when you sit there and look at the cost per ton of iron ore. I find it amazing that, that's all they're getting for a ton of iron ore that they are taking and shipping to the other side of the world, digging out of the ground, putting on giant trucks. I think it's pretty amazing. But once again, remember, miners are very, very capital intensive businesses. I'm always going to trade for a lower PE. The other thing is that there's a lot of risk in there because they don't control the price. All right. So miners are price takers. meaning whatever price the market sets, they can either take it or not. They can not sell, they can slow down production, not sell, but once again, you have more risk added in there. That's why miners would be lower, and financials are almost always lower. So sort of same thing, right? If we talk about the amount of capital that you need from a financial, of course, capital is what they are doing to make money. So you need money to lend money out and actually make money. So all those are going to be lower. Now, there is no right or wrong answer for what that PE ratio is. So what I would do is I'd start looking, once again, as a relative valuation technique. Don't look at financials and say they're cheaper than technology companies, because they're always going to be cheaper than technology companies. Go in there and look at the different financials. So in Australia, the simple one, go look at the big four banks and then sit there and say, okay, some are trading at different levels than others. Why? Is there a reason for that? And do you believe in that reason, right? So look at how the market has priced those and figure out, okay, is that something that you actually believe in? All right, so that was a long answer to the anonymous attendee, but Lisa said, with so many global existential risks now compared to when the stock market launched, is it still a viable investment entity? Okay, that's a good question, Lisa. So Lisa, of course, is down with the alpacas. Lisa's 3 alpacas. So, okay, it's a really good question. So let's talk about, and I actually said this on this Instagram post I put up this morning. Let's talk about the share market. Now, this sounds counterintuitive, but as the share market falls, it actually becomes less risky. And why I'm saying that is a valuation level, I think, as I said in the beginning, a valuation level is really just future expectations. So when I think things are going to go great for a company in the future, I'm willing to pay more for it, because that company is going to grow more. It's going to pay me a higher dividend. It's going to grow its dividend. And I have these very rosy scenarios. I'm going to pay more. Same thing for the market as a whole, right? When I have really rosy scenarios, and if we go back, essentially I was going through trying to find quotes on this. We did a technology podcast back in March of last year of 2021, and we looked at market crashes and talked about what was priced into the market at the time. And what was priced into the market was really low inflation, a fast recovery from COVID in terms of earnings, low interest rates for years out in the future. And that market, of course, was priced for perfection. Now, there were all different reasons why that was priced into the market, right? So there are plausible arguments for all of it. The high valuation levels were because we were seeing a lot of growth out of COVID, and we knew economies were opening up again, and we knew that would lead to more profits. Why do we think interest rates were going to stay low? Because everyone told us they were stay low. And not everyone. All the Reserve Bank in Australia, the Federal Reserve, all the central banks came out and said interest rates were staying low. So, of course, we believed that. Why do we think inflation was going to be low? Because we kept pumping more money into the economy, more money into the expand the money supply, and inflation didn't change, right? So it stayed low. It stayed low through these massive central bank interventions that occurred back in the GFC. It stayed low originally with some of the COVID interventions. Well, those were our expectations. Our expectations were very good. A best case scenario that we could pour all this money into the economy from both central banks and from governments, and everything would be fine. But those are all our expectations. Now, obviously, those have all broken. And now what's happening is we're getting to the point, and we will get to the point at some point, I don't think we're there yet, where our expectations of the future are so low that we can't help but exceed them. And if you think about sort of what happened late last week that triggered this couple really bad days in the market, it wasn't the absolute value of inflation. It was the expectations that the market had, the expectations that inflation had. We've already seen the peak inflation in the US. And when that wasn't met, now we've all spiraled into these doomsday scenarios. And I don't know what's going to happen. But what I do know is that as these expectations change and get so low, as I said, that is when it's going to be time to buy. So Lisa, the answer to your question, that was a long-winded way of doing it, is that when people start questioning if the market's a viable investment entity, that's normally the best time to buy. So personally, I don't think we're there yet. But just remember that naturally, as you question, is this a good idea? Is everything going to fall apart? That's the best time to buy. So we saw that. And I think the GFC is the best example of that in my lifetime. But, when we're looking at the GFC, there were lots of questions out there whether capitalism would survive, whether all the banks would collapse. There was obviously a lot of anger at the government, at governments around the world for bailing out banks. There were a lot of questions whether, I remember talk of, will money come out of the ATM tomorrow? So that turned out to be a really great time to invest when there were such low expectations, and such low expectations, I think, for the economy as well. So yeah, I don't know if we're there yet, Lisa. I don't personally think we are, but just remember that you questioning that is, of course, natural. All right, so Phil's saying, Mark, there are those that believe in staying almost fully invested and that time in the market is what matters. Then there are those who keep cash reserves deployed or buying opportunities like now. First plays on my FOMO, but my brain favors the latter. How do you reconcile these opposite views in your head? Yeah, listen, it's a tough one. The two things I guess I would say, and there is no right answer. Time in the market, of course. Okay, the best way to invest, if you could do this, if you had a crystal ball, is of course you would be a market timer. If you knew what was going to happen, if you knew the future, then you would be a market timer, because of course, because you know the future, that of course would work the best. So, the time in the market, what they're really saying, people that are advocates for time in the market, is that you will not know when to sell and you will not know when to buy, and you'll get that wrong. And they are right. Most of the time, we get that wrong. And we get that wrong, as in, there weren't a lot of people out there yelling in early January that now is the time to sell. The market's just hit a peak and we're about to go into a bear market. As Lisa said, we don't exactly know. There are a lot of people that are looking at the market now and saying that it seems really, really risky, and maybe now is the best time to sell. So that has happened for thousands of years in all sorts of different bubbles. But market timing is very, very difficult and doesn't really work. So I think what people are saying with the time in the market is just a little shorthand way of saying you don't know. So just keep your money, stay fully invested all the time. Then there's this other one, as you said. The other one is saying keep cash reserves. Now, I will say this is what I've been doing. So I've been talking a lot on the podcast about it. We'll put out sort of early July, every 6 months. I kind of go through our own portfolios and talk about what's been going on. So I will say that, I was someone who was a little bit worried about valuation levels. So, 4 years ago, 5 years ago, I started not selling anything, but I started just not investing anything. So I would take contributions that go into my account, I just stick them in the cash. And so my portfolio is around 25% cash now. And it's obviously going up as the shares fall. And also I turned off my dividend reinvestment and let cash build up that way. And more than me thinking I could time the market was because of the returns that were occurring, I just didn't think I needed to invest anymore. Because even if I was wrong, and I was wrong, right? I left years and years of returns on the table, but I didn't need them because I had set my goal. I knew what return I needed to hit that goal, and I was exceeding it, even with a smaller part of my portfolio invested. And so I was just sort of focused on trying to hit that goal. Now, there will be a point now as the market keeps falling, of course, that required rate of return that I need to earn, that I was so confident that I was going to hit in January, even the 25% of my portfolio in cash, it'll get to a point where that's high enough that I'm going to need to invest that money. And of course, will come at lower valuation levels. So, I think more than anything else, and kind of what you can do if you're feeling jittery, is go back and make sure you have a plan. What are you trying to accomplish? And actually spell out that plan and spell it out by defining your goal. And we've obviously done a lot of these on goals, but go back and try to figure out, okay, what am I trying to accomplish? what's that return I need to accomplish that, and then look at your portfolio, and hopefully that can provide some guidance. Because the problem, Phil, is when do you know when to invest that money? And that's sort of the problem that, of course, I have. And I think I've tried to be honest about it, that I had a lot of cash during that COVID market dip. And I thought the market was going to keep going lower, so I put very little in. So I think that's kind of the challenge. What I'm trying to be guided by is my goals, and sort of when I need to get more money back in the market, rather than trying to catch the bottom, which I know is going to be impossible. So Lisa says, a finance journalist once said to me, never invest more than 10% of what you're willing to lose. My stocks portfolio is around 10% of my net worth. Okay, so a finance once said to me, never invest more than 10% what you were willing to lose. My stock portfolio is around 10%. Okay. Yeah, I mean, I think that's interesting. I think, listen, 10%, it's, we are all different. So, I would say, like, if I sit there and look at my net worth, I have the vast majority of it into the share market. Now, I still have a ways to go before retirement, and I don't own my own home. So obviously that's a big component of it. But yeah, I mean, I think the question is, in terms of like what you can lose, we could also see, and I'm certainly not an expert in anything, but not an expert in housing prices. But there's also obviously a lot of articles out there that with higher interest rates, looking at property in Sydney and Melbourne at the very least, a lot of banks are calling for 20% drops in property prices. So yeah, I mean, I think we just have to realize that there can be fluctuations in everything. And more than anything else, if we look at those short-term fluctuations, they're all different. We're all different life stages. Is just what you're trying to do is, of course, not get in a situation where you do panic and sell everything. But thank you for that, Lisa. All right, so I tried to make this one a little more topical because of what's going on. An uninsured home after a flood goes through it is a huge loss. That is true. That is true. But luckily, I live on the third floor and don't own my place. But anyway, thank you guys for joining. As always, if you have any questions, and I'll get back to some of the emails that I missed when I was on leave, which unfortunately ended yesterday. But any questions, just shoot an email to mark.lamonica1@morningstar.com. And thank you guys for joining.